I am, all right, now I can go. Good morning, everyone. My name is Scott Sonnier. For those that don't know me, I own an RIA firm, registered investment advisory firm, that I do a lot of work with Rick on the asset management side. Our business really is tailored to individual businesses, small and medium-sized businesses, finding and helping them implement tax advantage programs, business continuation strategy planning. We design plans to help attract and retain employees. So this will fit into a lot of you's warehouse, wheelhouse as well. So I want to go over one of the plans today, and then if there's any questions or anything that you guys are looking forward to bringing to the table, I'd love to answer them. Let me share my screen with you now. So what we like to do is to try to find all the tax advantage tools that are out there to maximize our clients' lives and their business lives. More money we can save them by their silent partner, aka Uncle Sam, the more money we can then manage and put to work for them. One of these tools is called a cash balance plan. So let me back up right here. All right. So what we're trying to do is familiarize you with one component of the retirement plan space and introduce you to something that some of you may be familiar with, but added some additional components or amendments to this. And what I mean by that is this is not one plan. This is 5 components of a total retirement plan. One being the 401k plan and profit sharing. Most of you know that. Most of you understand you can put away $24,500 into a 401k plan as a individual, then the business can drop in the rest. Last year, that was $71,000 in total. This year, it's up another $1,000. So still, I don't care if somebody's making 100,000 or well into $1 million. The most they can put away into any defined contribution plan is still only that $71,000 for the year 2025. And oh, by the way, we can actually still set up a 2025 retirement plan for those that need it. So if this is something that you're looking to do or would like to bring to the table, we can actually help them do that. Now, the additional components, this is where the other retirement plan comes into play. This is the defined benefit plan or your pension plan. It's a scaled down model of a pension plan that your General Motors, unions have, airlines have. This is your 412E3. But the big difference is instead of having a payout, a monthly payout for the rest of their lives, they just get the cash balance. So the pension side actuarially costs a lot less because we don't have to try to worry about paying somebody for the next 20, 30, 40 years of their life. All we simply do, whatever their cash balance is when they retire, we give them that and put it into we can put it into their IRA. Okay. The next component, which may get you guys excited, is the aggregated benefit. This is the 401h component. So I like to equate this to an HSA account on steroids. So think of anything that you can pay for your health, your medical, your life with your HSA. So think long-term care. You can actually use your 401h for. And instead of only being $8,300, $8,400, this is in excess of $20,000, $30,000, $40,000 or more. And then the great other piece of this is if there is any money, so let's say the maximum you can contribute to this account is $300,000, you only put $200,000 in. That gives you a carry forward contribution for the next year of another $100,000. That's your tax reserve. So in these great years that you have every so often, we actually have a catch up that allows people to put more money than they normally would, because all those previous years that they didn't maximize their contribution rate, we now have the ability to add it in that year. So when you think just these 401k plans, you're looking at 82,000 if they're between the ages of 60 and really 63, by the way. Anybody above the age of 50, all the way up to age 60, they can put away 77,500. That's just on the 401k profit sharing side. But when you add the cash balance component, now we're doing 4, 5, 6 times the amount of money in total that they get to put away, tax deducted, growing tax deferred. So, and if there's a need for life insurance, that's where that 401h component comes into play. So it's a really great tool for us to buy life insurance with tax deducted and potentially tax-free dollars. So the plans are tested. So we do have to meet discrimination testing, but we don't even worry about that. That's where a third-party actuary comes into play, just like all retirement plans, and they're the ones that test all of this. Now, what is unique about these plans is that because of the 401h, the aggregated benefit side, we get to put away 33% more than what a regular cash balance plan would be able to do. So if they're putting away only 100, we get to put away 133,000. So we can increase the amount of tax deductions and yet still provide them an amazing benefit that they normally would not get by not using the right TPA and not having the right plan design. So if you think of the front end, a cash balance plan looks and feels just like an old-fashioned savings account, right? They're credited based on the amount of money that they have, their age, and how close they are to retirement. So younger people do not benefit as much as older people. Higher paid wages and older benefit the most compared to a lower paid person at the same age. So the factors that really help these become a massive benefit is age, high incomes, lower employee count, and a larger discrepancy between how much they're earning and how much the rest of the employee base is. What you end up being able to do is, because of this post-retirement individual medical expense benefit, we now get to deduct what is in essence a major expense in a retiree's life, which is their health and medical expenses. We now get to pre-fund that, take a tax deduction, it grows tax deferred, and it's pulled out tax-free for all health and medical benefits, including the life side. So this adds a really dynamic benefit that most are not able to do or not even thinking about. They're not even aware they have that. So here's your codes, and here's an example of a case where you've got a high paid owner. You do have one highly compensated employee in this arrangement. You've got some rank and file employees. We're able to put away in the neighborhood of 95 cents of every dollar goes to the owner in this scenario. So this is a perfect example of, you think of CPA, engineering, architects, law firms, pharmacies. These are ideal for these types of businesses. So with that being said, I think we've reached our 10-minute timeline. So I'm going to stop sharing. If there's any questions and or comments, please let me know. If anybody would like some more information, just reach out to Jim here, and he will definitely make sure you have my contact information to either questions, concerns, or fill out a design study.